everyone. Good afternoon or good morning, depending on where you are. I'm Izzie Henderson, our Senior Product Marketing Manager here at Amberdata, and I'm really happy to welcome you to today's webinar, Leveraging Institutional Bitcoin and Ethereum Metrics for Trading Signals. Every metric you will see and hear about was developed by us, and you can find them on AmberLens, which is our market intelligence platform. So please go to amberlens.com for more. During the webinar, please submit any and all questions you have, and we will get to them at the end of the session. The recording will also be available on our YouTube channel, and you will receive an email with the video once it's live. And as a reminder, nothing said here is trading advice and is only an interpretation of the market. Okay, so let's dive into things. I'm super excited to be joined by Chris Martin, who is our Director of Research, and Christian Manaog, who's our Senior Research Engineer. Hey guys, welcome.
Hey,
So,
thanks for having us.
Of course. Chris, I'm going to hand it to you first for just like a brief introduction and a description of what your research is most focused on, and then Christian after.
Yeah, thanks, Izzie. I am the Director of Research here at Amberdata. Our research team is primarily focused on the development of new metrics like those that we see on AmberLens, as well as those dashboards that you'll find on AmberLens. We also support our internal teams and our customers. Prior to Amberdata, I was a lead data scientist at Coinbase, focused on crypto and blockchain analytics. Even prior to that, stockbroker and data consultant focused on finance and fintech.
Awesome. Christian?
Yeah, so I also used to work at Coinbase. There I worked as a blockchain researcher, where my primary responsibilities involved maintaining Coinbase's address metadata store. I worked on blockchain analytics as well as things like OFAC compliance and other cool blockchain-related research projects. Here at Amberdata, I work with Chris to help drive new metrics and also develop valuable insights for our customers, which we'll be talking about today.
Great. Thank you both. Okay, so let's just kick it off with some context. So Christian, can you just tell us a bit about what makes these metrics institutional and even like why you and the team decided to build these in the first place?
Yeah, so a lot of these metrics come from an institutional report that Fidelity produces. And we think that these metrics are sort of the base layer of insights that people should be looking at when they're looking at networks such as Bitcoin or Ethereum for fundamental understanding of like whether we should be, the state of the market, buy or sell signals, etc. Right? These are sort of the core metrics that most people are looking at when they do sort of technical analysis. So that's sort of why we're going into this today.
Thank you for that. All right, let's just dive right in. So first, let's talk about our top bottom indicators. And first up is Pi cycle. So when I'm looking at Pi cycle, I'm generally trying to see price behavior, right? Like, is a cycle overheating? Are we heating up? So Christian, what signifies the market top and where are we now in the cycle?
Yeah, so the Pi cycle top indicator is a cool metric. It involves two moving averages, the 111-day moving average and the 350-day moving average of the asset, so either Bitcoin or Ethereum, up price, of course. And so whenever the two moving averages cross, that usually indicates a top signal. The top signals usually follow within 5 days of the cross. So pretty much everyone who knows about these metrics are always looking for this, because once you see it, it's pretty much you gotta leave like right now. So the cool thing about this metric is that it's pretty easy to tell when they'll cross, because once the line crosses the 350-day moving average, that usually drags the 111-day moving average up. So if you look at the charts, you can see like every single cross is predicated by Bitcoin movement above the 350-day moving average line. You can see in the past month, it was 2024. The last time that happened was like earlier this year, but we didn't stay above it. And so the two lines did not cross, which is why this metric does not deliver a top cycle indicator for this past market cycle. So either that means the market cycle is not over and there's more to go, or that it's potentially just not capturing this one particular cycle within a larger cycle.
Got it. And so you wrote this new research paper, which is called Pulling the Signal from the Noise on Bitcoin Trading Strategies. How are you using Pi cycle to find trading signals?
Yeah, so because it's a top signal, the pi cycle top is a really useful metric to know when you should leave. And in general, a little bit about the paper itself, pulling signal from the noise, right? If you read it, you'll see that a lot of the strategies are pretty straightforward. They're very not basic, but they're intrinsically understood because they take what the metric says it should do, and then we just do it, right? So in this case, the pi cycle top indicator says that we should sell when the two lines cross. So in our metric paper, in our signals research paper, right, whenever they cross, that's when we sell. And so, the number of times it's crossed, if you look at the Bitcoin side, it's probably like 4 or 3 times, right? So that the number of times we can sell in our trading strategy will only be around 3. So the number of trades is pretty low, but the amount of return you get is very high, right? And so the whole point of this paper is sort of to give us a baseline understanding of like, if we just use these metrics, right? Like how much return are we going to get from just the base, understanding of the metric. Yeah, and so for pi cycle top indicator, it does pretty well. Well, but by itself, it doesn't do very well, but we'll see in a bit when you pair it with the bottom indicator, it does very well.
Awesome. Thank you for that. And so let's move on to market cap versus realized cap. So Chris, I mean, to me, when I look at this, it's a bit deceiving, right? This is such a useful metric, looks fairly simple when you're just looking at it, but what are the nuances between calculating this for Bitcoin versus Ethereum, and how is that changing your analysis?
Yeah, you're right. This is a tricky metric. So the realized cap is essentially the cumulative price of all of the tokens at their last move price. Compare that to market cap, which is the supply of tokens multiplied by the market price. So as you calculate this metric, when the token prices move upwards and tokens move more quickly, the realized price of those tokens increases. So therefore, the realized cap will also increase. One interesting dynamic here is that when the token price moves upwards and you do not see an increase in realized cap, that means that older tokens, generally older tokens, are not moving as quickly. So we could see this back in end of 2023, beginning of 2024, especially on Bitcoin. The price appreciated quite quickly, and realized cap did not move nearly as quickly. So essentially, older tokens were being held for longer than the market price would appreciate. So to go back to your question about Ethereum, this calculation is much more complicated for Ethereum than it is for Bitcoin. For Bitcoin, it's a UTXO chain, so all transactions create an input and an output. Account-based chains like Ethereum require some accounting magic to calculate this realized cap. One of the things that you need to know to calculate realized cap on Ethereum is you need to have not only every transaction on chain, but you also need to know the price at every time that that token moved. So it is quite a complicated metric to calculate. And I think that its value is extremely useful, especially when understanding the sentiment of the market when you're considering, are holders holding for longer, or are they appreciating their value as the price moves up?
Gotcha. And so Christian, what is the macro signal here, and where are we in the market currently?
Yeah, so one cool thing that Chris mentioned, right, is that because it's a realized cap sort of captures the value of the market, like how much realized market cap has been, acted upon. When the realized cap crosses the market cap, that's usually a bottom signal. And so when we pair the realized cap signal, right, the realized cap crossing market cap and the pi cycle top signal, we have a really good trading strategy. It only performs 3 trades, as you can see on this graph, right? You can see there each green line indicates a trade where we had a gain. And so, if we rely solely on this strategy of like, let's just trade when realized cap and market cap cross and when the 2 pi cycle top indicators cross, right? We get this pretty cool strategy starting in 2015 where We started with $100,000, and I believe we end with like somewhere close to 10 million, if I remember correctly. I could be, yeah, pretty good. You have an oversized return, 243%, I think. Sorry, 189%, 189,000% return, as you can see on the top. And one interesting to note, though, is that in 2022, when we made the last trade of the trading strategy, the end is where we ended the back test, but we didn't actually sell off at the peak of this current market cycle. So that might indicate that as the if Bitcoin continues to drop or slides further down back into a bear market, right? Like this backtest would not be as performant as before. So really, everyone's job, right? If we want to make this a real trading strategy, is to sort of figure out better top cycle indicators, right? Like take the top cycle, do some grid tests, and like try to figure out like what the real ceiling should be, so that we can capture even this past top market cycle.
Thank you for that. Okay, let's move on to Bitcoin Yardstick. So for me, this is such a fun chart to look at, and it's one I definitely return to all the time. So Christian, where did the ideation of this metric come from? Like, why is it called a yardstick?
Yeah, so the Bitcoin Yardstick was invented by another company, I believe Capriol Investments, and it's a simple approximate measure of Bitcoin's valuation. So the idea here, right, is that like how we use yardsticks to approximate distance, right, like we want to use this metric as sort of an approximation of how valuable Bitcoin is, relative to its price. So the metric itself is the market cap over the hash rate. And the idea there is that the hash rate is sort of the amount of money spent to secure the network. And so the more money being put into the network, but the smaller the market cap, that means that there's Bitcoin is undervalued, and then vice versa. If the market cap's really high, but there's not a lot of money securing the network, then it's overvalued. And so we get this pretty intuitive graph here at 3, 2, and -1. These bands are sort of the buy and sell indicators for this metric. And so we can see that the metric has crossed in a few times in 2017, 2021, right, in the past bull cycles. In this past market cycle, we actually, even though it looks like it hits 3, it actually doesn't hit 3. I believe the highest value it hits is like 2.96. So we didn't actually cross the threshold for expensive Bitcoin, and to me that kind of signals, right, that like we shouldn't be too strict on like what the actual band is, right? Like, because I think if we lower the band like even 0.05, right, we capture a little bit better of what's happening in the market, right? Like even though the suggested values are 3, 2, right, like you shouldn't feel constrained to just rely on that band.
Gotcha. So then where is Bitcoin now? And what is that telling us about, the market bull bear cycles and where we're headed over the next few months?
Yeah, so as you know, Bitcoin price increased a lot with the Bitcoin ETF. So if we zoom in to the past few months, we can see that there's a lot of price volatility that relative to past market cycles, right? This is sort of like unusual, I would say, like go these wild swings in the metric between March and July. To me, that means that Bitcoin is still trying to find its price foothold. And so we don't really, it's pretty uncertain. And especially because we didn't hit the overvalued section of Bitcoin, makes me think that the market cycle hasn't really finished yet. That's what the pi cycle top indicates too. So it's very possible that like we could see an easy rebound for Bitcoin, and it continues to go up past into the expensive zone.
Thank you for that. Let's hope.
Yeah.
All right, so on to market sentiment. So we're looking at net unrealized profit loss, or NUPL. So Chris, can you tell me a bit about what these emotional states mean and what each signals about the market?
Yeah, so to differentiate the previous set of metrics to this set of metrics, the top bottom signals are kind of like a gauge to the state of the market cycle. Market sentiment is more of a gauge on how the community, how the industry feels about these tokens. So if we look at the net unrealized profit loss metric here, we could see if the network is in a state of profit or in a state of loss. So as the metric moves up, you can use a more positive word like euphoria, belief, optimism. But as that metric moves downwards, you would use the more negative word like greed, denial, and anxiety. If we look at where we were in the bear market in 2022, um, both Bitcoin and Ethereum were in a state of capitulation. But since 2013, the network and the tokens underlying these networks really started to appreciate in price, and sentiment became a lot more positive around the end of 2023, beginning of 2024. Recently, though, there have been a lot of FUD events. There's been a lot of fear, uncertainty, and doubt in the industry around not only macroeconomics, around the U.S. presidential election, but there's also big events like Mt. Gox and the FTX distributions, etc. This has shown a lot more on Ethereum than Bitcoin. Ethereum has since fallen to almost a state of capitulation, but it has since rebounded a bit. So I think only time is really going to tell how this plays out. But I do see Ethereum especially not staying in such a low, I would say a low state of sentiment. I think we could see it rebound in time as these events play out, and as the market either returns or we get some clarity on which direction we're going to head from a macroeconomic standpoint.
Yeah. And so, I noticed that even though the bands are slightly different and obviously the timing is different, but Bitcoin and Ethereum do seem to follow similar trajectories, like really from 2018 on. Is there a correlation there? And what does that tell us about sentiment?
Yeah, correlation is definitely there. I think Bitcoin and Ethereum, even on your average day price momentum, have been correlated since the beginning of time. There are some cases where Bitcoin and Ethereum do lose this correlation, especially in our current environment. Um, but if we look at this metric specifically, we can see that the y-axis is far different from each other. So Bitcoin generally is in a range of minus 0.3 to plus 0.5, whereas Ethereum has been in a range of -1 to +1. So the sentiment on Ethereum is far more volatile than it is on Bitcoin. I think Ethereum's profit loss sentiment has been a lot more conducive to news events and a lot more just in general higher sentiment swings. Bitcoin, it makes a lot of sense that Bitcoin's not as volatile as the token. The network's been seen as sort of an inflation hedge, a lot more stable, and even things like supply on Bitcoin is fixed, whereas on Ethereum, it's been going through a lot of changes, especially with the staking upgrades and all of the network updates that have been made in even the last 3-4 years.
Yeah, thank you so much. And so then Christian, just on NUPL still, tell us about your trading strategy. Like, what are you seeing here?
Yeah, so this is another graph from pulling signal from the noise. And what I like about NUPL is that because it gives you the emotional state of people in the market, when people are feeling good, that usually means the price is high. And when people are feeling bad, that usually means the price is low. So the obvious strategy here, right, is that if we try buying when people feel bad, and then we try selling when people feel good, right? What I think is cool here to notice is that even though this strategy makes sense in theory, NUPL is almost a little too aggressive with selling off, right? So again, like the green lines indicate trades where we made a gain. And here we see our first sign of of trades where we did not make or where we took a loss. These are the red lines. This comes from our 10% stop loss that we put on our strategy. This is if your value or portfolio decreased more than 10%, right? You sell so that you don't lose too much, right? You're protecting your portfolio from sliding too far, and so just I forgot to mention earlier, but because these are simple strategies, we're not doing any sort of like order sizing or anything. So we just buy with our full equity and we sell with our full equity, right? Whenever our signals are reached. And so we can see here that we take some small stop loss, but in general, when NUPL does give us a gain signal, right? It's almost like not capturing the full trove, trove to peak in a market cycle, right? So like in 2019, mid 2019, right? It buys like towards the end of 2020, and then it sells like at the beginning of 2020, instead of holding it through mid 2020 where it hits like a new market high, right? So to me, like NUPL is like good at finding these smaller micro peaks, but it's not great at finding like the true top of a market cycle. So like again, what's cool about these metrics is that you can play around with them, right? Like try different parameters, right? You don't have to use the lines that are suggested for like your trade signals, right? You can use grid search and back testing to sort of find more optimal spots, right? And then maybe you can try to tune to find a way to capture these higher peaks, right? Or you can combine NUPL with other metrics to try and find better top signals. But yeah, I think market sentiment is generally really useful when doing trading, because when you trade, right, like in retrospect, right, it looks obviously you buy in 2019, you're like, oh, I should just definitely hold until mid 2020, right? It's so obvious, right? But when you're in 2019, you're like, oh my gosh, the crypto market is falling apart. Like
Yeah.
I don't know if you remember on the NUPL chart, the 2019 ETH NUPL was like -3. So like ETH maxis were depressed. So like
Definitely.
same here, right? Like you don't know like how people are feeling unless you have some sort of like gauge, right? And I think having that market sentiment is really useful to sort of understand what people are feeling at that point in time, right? Irrespective of the future, right? Because you can't see into the future when you're back testing.
Good. Thank you for that. And also just a quick plug, this paper will be emailed to everyone who's registered for the webinar. So you'll be able to read a lot more on this later. Continuing on with market sentiment. So Bitcoin HODLing, there was a massive decrease in HODLing up until this recent month. Chris, is that generally a bull market indicator? How do we interpret this?
Yeah, I'd say this metric is neither bearish nor is it bullish. You can see that massive drop happening in June. What happened in June was the price was extremely volatile. Bitcoin went from near all-time highs of 70K back down to 60K, back up again. There was a lot of price action happening. If we consider what this metric represents, it's really a measure of how many tokens long-term holders or hodlers either accumulate or sell. Generally sell, it could be a transfer, but let's assume that it's a sell. As the position change decreases, so as you see a large decrease, like we saw in June this year, holders are likely taking profits. They're selling when the price is high. They're taking revenues, and that makes sense intuitively, right? You want to sell high, buy low. So on the flip side, as the metric increases, as we see a dark blue line in any month, that means that long-term holders are accumulating more tokens. Buy low, and that makes sense. So given where we're at right now, I'd say June is certainly a lagging indicator. Price action happens, and we see this large increase or decrease at the end of the month. One of the things I'd point out here is that if we look at July 2024, the net position change is relatively flat. It's not even visible. That's how small it was. So I think if we were to use this metric to gauge the sentiment of long-term holders, I would say they're currently in a state of wait and see. They're currently in a state of hold, not accumulate. Let's see where the market goes from here. This makes sense, right? Especially in August so far, we've seen another huge volatile shift in prices. We're back down to 60K on Bitcoin. Time will tell. This is a lagging indicator. So in hindsight, we can make these decisions a little bit rationally, but unfortunately, right now, I'd say we're neither bullish nor bearish. Long-term holders are waiting.
Sure. I feel like the theme for this year is just wait and see, maybe for the last 5 years. Okay,
Yeah,
great.
it's especially on a daily on the daily basis.
Oh,
Wait and see
absolutely.
is not a bad play.
Okay, great. So on to user activity. So then new address momentum. So Christian, what is new address momentum and why is it helpful?
Yeah, so new address momentum, I think, is a pretty intuitive metric for people who've never heard about it before. Basically, a new address is when an address first receives either Bitcoin or ETH or an asset in general. And so the point of tracking this metric is that it sort of acts as a proxy for activity on the network, right? The more new addresses you have, the more either new people are joining or people are using the network, right? Like in general, you want people to be using the network, right? If people aren't using it, then only a select few people are using it. Then you're not really capturing the value of what the network is offering, right? So here, the new address momentum gives us the 30-day new address momentum and the 365-day new address momentum give us the trend lines of like how much activity is happening on each network. You can see an interesting facet for Bitcoin is that the 30-day new address momentum has been decreasing over the past few months, even though we had like historic price action, right? So what that means to me is that people are not sort of investing in Bitcoin the same way they were in 2018 or 2021, right? Like a lot of this momentum is coming from new ways to invest in Bitcoin, such as the Bitcoin ETF, right? And so, I think new action momentum can tell a lot about the state of the network, right? Like, are people using the network itself? You can see in Ethereum, right? We see large spikes in network usage throughout the past like 10 years. 2018 was a big one. When we were in the bull cycle in 2021, there was another large spike. And then here we see also a slight decrease. Yeah, and in general, right, like we can do a lot of cool things with the daily moving average, which we talked a little bit about in the signal, pulling signal from the noise report.
And so then how does the current state compare to previous cycles, even if the cycle isn't over?
Yeah, I mean, I think it's similar to what I said, right? Like we see a decrease in action momentum for both Bitcoin and ETH. And so I think, again, it really just shows sort of like the state of the market, right? Like how are people interacting with the network? They're not doing it by buying Bitcoin on the network, right? Like they're doing it by going to these ETFs and investing through ETFs. Right. And so instead of, a lot of new addresses being created, right, a lot of it is being centralized around these like main actors who are pulling in a lot of Bitcoin and not necessarily creating new address for the address momentum to shift. Typically, you do see a lot of new address activity when there's these like huge price market, when there's huge price action, but we don't really see that. So I think it shows that Bitcoin is evolving, right, as a network. Which is pretty cool.
Thanks for that. So then on to daily address activity. So Chris, how do we calculate address activity?
Yeah, so essentially, daily address activity is a look at users taking action on chain. So if we define our active addresses are those that actually have to make an action on chain. So on both Bitcoin and Ethereum, an active address would be somebody initiating a transaction. They have to make an actual signature to transact. this is an action that must be taken in order for them for the transaction to be created, of course. A passive address, on the other hand, is an address that doesn't actually have to take an action to be seen on chain. So in the example of both Bitcoin and Ethereum, a passive address would be somebody receiving funds. So they simply have to sit back and enjoy the funds being transferred to them. So I think a couple of the things that are really interesting to look at here is on Bitcoin, actually both Bitcoin and Ethereum in general, the number of active and passive addresses has really stabilized over time. I think this is a really interesting dynamic. We don't see any days where nobody's using the networks. I think it's relatively stable around 500,000 on Ethereum to around 800,000 on Bitcoin in any given day. Where you can pull some insight out is, let's take for example 2023. 2023, the beginning especially, was a bear cycle, but later half of the year, the second half starting around October, we saw a rise in ordinals, we saw a rise in BRC20s. There was a lot of talk about Bitcoin layer 2s, which has not died out, by the way. And we're seeing a lot of activity re-emerging on the network. So you see a spike from 600,000 to about 800,000 daily active addresses. On Ethereum, there was no significant change during that time. Things were pretty steady. Everyone moved to Bitcoin to do some ordinal transactions, and nobody was playing around on Ethereum in the same manner. Then come March 2024, we had a lot of Ethereum hype around the Ethereum ETFs. We had a huge meme coin wave, especially on Ethereum layer 2s like Base, and address activity picks up again. Now, both of the networks, the current state is about return to the steady state. I think there is another interesting dynamic that happened on Bitcoin very recently. If we look back just on this year, starting around maybe April, but more recently June and July, we can see passive addresses are actually overtaking active addresses. This has happened in the past before a couple of times, but I think right now it's a really interesting signal that there's either a lot of spam happening on chain, meaning a lot of people are receiving funds without doing any actions. I don't think that's the case. I think spam has been consistent throughout Bitcoin's history. Or there's centralized exchange consolidation. Large exchanges with many addresses are moving funds around for either cold storage or topping up hot wallets, whatever's the case there. But my opinion is most likely trading has moved from on-chain transactions to centralized exchange trading. So a lot of funds on the ETFs, they're all using a centralized exchange of some type as a custodian. Institutions are likely to then use centralized exchanges as their trading venue rather than transacting on chain. I think as institutions, for example, they are generally the largest volume traders, move more towards centralized exchanges. There's an interesting dynamic that happens there, which is centralized exchanges have a lot more liquidity and therefore a lot less slippage. And sometimes centralized exchanges can reduce fees. So you'll see, we may see this dynamic play out over time where there are less active addresses on chain, on Bitcoin and Ethereum. You'll probably still have these for networks that do not have an equivalent ETF or longer tail blockchains. But you'll see a lot more trading happening on centralized exchanges.
So then do you see address activity decreasing as almost a sign of the maturation of the industry in general?
In a way, yeah. I think as we have new paradigms like ordinals on chain, as Bitcoin L2s eventually roll out, Ethereum L3s or what have you roll out, I think we may see some return to on-chain activity, but I don't think that a decrease in address activity is a bad sign, especially when combined with centralized exchange trading volume. As long as that goes upwards, right, the industry is benefiting as a whole. But it will be an interesting dynamic to see play out.
Thank you. So now let's close out on our miner and supply metrics. So first up, we have the POEL multiple. Christian, what is the POEL multiple?
Yeah, great question. So the POEL multiple was invented by David Poel, who is a Bitcoin legend in terms of the metric world, if you know about him. And so like the high level understanding of the metric is that it's very similar to the yardstick, right? It kind of measures Bitcoin valuation relative, well, not relative price, but relative to miner rewards. So here, what we're doing is we're looking at the, in the numerator, we have the daily issuance from miners. So basically like how much money is the miner making, right? In terms of transaction fees and the Coinbase reward over its 365-day moving average, right? And so this sort of gives us and then we take a z-score, right? And so this gives us a measure of how much miners are making, right? Relative to the network. And so, you know, if miners are making a lot, that means the price of Bitcoin is going up. Right? If miners aren't making a lot, that means like there's not a lot of network activity, and so they're not making as much, right? So the lines here are I believe at 1 and 4. So when the POEL multiple crosses the long line, it means that we should be investing in Bitcoin, and when we crosses the short line, it means that the price is very high, and we should probably sell. Yeah, so that's what it means.
So right now, I mean, it feels like, I mean, looking at it, it looks like we're, you know, long or long-ish for Bitcoin, but it feels like we've just had recent peaks, you know, highest prices ever for Bitcoin. So how does that correlate? And maybe this is a part of that new trend of, you know, a more mature ecosystem outgrowing this metric.
Yeah, I agree 100%, right? Like if we look at this metric, right, it was invented earlier in the Bitcoin life cycle, right? So, you know, when it crosses the short metric, it really crosses the short metric, right? Like in 2014, 2013, I believe, 2018, right? Like it really like punches right through the short line. Since 2018, right, we haven't seen the POEL multiple across the short line, the suggested short line. And so, you know, to me, that means this metric is sort of needs to evolve in a way, right? I think the line for short should be lowered a little bit to match the smaller and smaller cycles we see, right? So even though right now we're in a short position, right? Like there was a peak, right, in 2024. A few weeks ago, you can see like it hit the POEL multiple hit the highest it's hit in like the past 2 years, right? So it's not that the POEL multiple is outdated per se, but I think we have to be more cognizant of how we interpret the short line, right? Like maybe it should be lower to like 3 or maybe even 2, right? And that can come with backtesting, right? Like if we look at these cycles, right? Like how are the cycles decreasing, you know, cycle to cycle, right? Maybe there's like some amount we can decrease by every single year, right? And so instead of it being a straight line, maybe it's actually like a negative sloped line, right? Well, at least until and it should level off, right? Because then it will cross, and that'd be weird. but but something like that, right? Like the market has matured a lot, and so you know, looking at miners is not as useful as it was in maybe 2012 or 2014, right? And so, especially with what I was saying, right? Like a lot of people are not investing in Bitcoin the same way they did in 2014. So address activity is very different now than it was then.
Got it. And so on to miner supply. Christian, what jumps out at you when you look at this metric?
Yeah, so miner supply spent is another cool way to analyze miners. So you know, miners, we define miners as as an address that receives the Coinbase reward, which is pretty airtight, right? Like if you receive the Coinbase reward, you are a miner, right? So what this metric measures here is that how much are these addresses spending relative to conserving, right? So if they're spending more than they make, then the value goes above 100%, and we get this dark blue line. And we're spending less than what they make, then they're holding, and we get this like light blue line, right? And so, well, this metric is on a 2-week window, and so generally you want to look for trends in miner supply spent, right? Like are miners generally holding, or are they hold or sorry, are they generally holding, or are they spending more? You can see in like I believe May 22nd to 29, right? There's like a long period where people spent. But like if we look in July 15th to the 20th, you can see that they held, right? So these like 5-day like cycles are generally like pretty good indicators of what miners are doing. And the reason we like looking at miners is that miners are obviously very invested in the Bitcoin ecosystem. So if you think that a miner is like a good, like, proxy for a good Bitcoin trader, right? Like their behavior sort of is very telling of like how the Bitcoin network itself is feeling about the price, or feeling about the network in general. So if miners are doing a lot of holding, that means that they think the price will go up. So you should probably follow suit. Vice versa, right? If they're doing a lot of moving and selling, then that means that they're not confident, right, that their price will go up. So they're going to, take their gains now. And so this is a very like micro level signal, right? Like you wouldn't generally look at this on like a, like a monthly basis. It's way more useful on a day-to-day sort of decision-making basis.
Thank you. And so Ethereum Active Validator. So Chris, this has obviously been growing steadily. What jumps out to me is the merge happened, and I think there was a lot of hype around the fact that people just assumed active validators would leave. Why didn't they?
Yeah, absolutely. I think the overall sentiment was after the merge happens, after Ethereum moves from proof of work to proof of stake, all of the validators securing the network will leave. They will take their yield and run. That did not happen at all, like you mentioned, and I think there are a few really interesting reasons why. First of all, I think it's a massive sentiment to the network. I think that it shows that that validators believe in the network, they believe in decentralization, and they believe in securing the network. From a security standpoint, more validators is better. You have more people staking their tokens, and the network is therefore more secured. Um, what we are seeing is that there are a few dynamics playing out, few reasons for validators to stay online rather than withdrawal. One of these is the rise in liquid staking tokens. You have assets like Lido staked ETH and Coinbase staked ETH that are returning yield to their investors. They're returning a passive income to holders, while at the same time holders are able to take part in that price appreciation.
Totally. And just a quick plug, Amberlens does have a liquid staking dashboard. So you can see, all the activity that's been going on there, but, has restaking even had an impact on the network? How do you think that's gonna happen moving forward?
Yeah, I think the liquid staking token area is really interesting right now. I think that there are some parallels here to stablecoins. I think that LSTs, liquid staking tokens, um, have solidified their place in the network, similar to how stablecoins have. They've become one of the new foundational layers. Stablecoins are one of the most liquid assets in terms of DeFi and DEX trading. They're almost always the highest traded asset on DEXs on a daily basis. And I think we're seeing the same thing happen on liquid staking tokens. I think you're seeing CBETH on Base really becoming that foundational, WETH equivalent. I think we're seeing Lido staked ETH and Rocket Pool staked ETH I think we're seeing these things solidify their space on other L2s. And yeah, as LSTs grow in size, the derivatives from them, like you mentioned, restaking, are also growing in size. We have EigenLayer showing a lot of potential to secure other protocols in the network. You see a lot of the overall ETH that's been added to supply continuing to be locked. You see validators continuing to move in, thereby adding to the value of liquid stake derivatives, adding to the value of restaking. And it's a game of where is your best yield? Is it holding the native asset? Is it holding a version of the asset that's been staked where you earn passive income? Is it restaking that staked asset to earn even more yield? And I think we're going to see this play out in a way that liquid staking tokens are going to be the new foundation, similar to stablecoins.
Thank you for that. Super insightful and super exciting just for this new market being opened. Okay, so sort of taking it back down as we enter our last few minutes here. Christian, we've referenced your report multiple times. What are some key takeaways you can leave us on your strategies?
Yeah, I think the report itself is pretty insightful in terms of if you want to know, like, oh, if I just took these metrics on Amberlens, right? Like how much money would I make? Like, right? Like straightforward, right? Like how much money could I make if I just traded on each metric? Some of them do really well, of course, and some of them do very poorly. And that's because I think the real art, right, of trading is that you need to take each metric, not for just its face value, but to sort of convert it into a more holistic approach, right? Like either like you have metrics vote, right, on like a top signal, vote meaning like if multiple signals cross, right, then that means like we're definitely in some sort of price action area, right? But if you know, if you don't do that, right, you'll sort of end up with these very simple strategies where we only make 2 or 3 trades. They're very sort of fragile, right? They break easily if you know, market drops unexpectedly or something like that. And so you know, a lot of the you know, burden is on the reader, you know, exercise left to the reader to sort of understand, you know, what are these metrics really telling us, right? How can we convert them into more interesting metrics? You know, like one freebie, right? Like I think the Bitcoin Yardstick, one way it could easily be improved, instead of market cap on the top, you can put realized cap, right? Like you do the feature engineering, right, to sort of create new metrics, combine metrics together to, you know, ratios of metrics give interesting insights. And like that's sort of the way you need to approach understanding these sort of like simple trading strategies to make them into more complex and stronger trading strategies.
Thank you for that. Okay, let's move on to a couple of questions. So we got one in the chat that says, how does Amberdata track monthly hodlers? Is it just supply that hasn't transacted in 30 days? Christian?
Yeah, I can answer that one. So that's not necessarily how we track it, right? Coin days destroyed is a metric that you may know. It tracks how many days a Bitcoin transaction, like, so remember Bitcoin is UTXO based, unspent transactional based. So it's kind of like cash, right? Like once you receive it, it sort of stays in this tranche, right? And so like in this tranche, right, depending on how long that tranche has sat there, right, that's the number of days old it is, right? So like, let's say you receive it like last year, it's 365 days old. If you move that tranche somewhere else, then we destroy those days, right? And that's coin days destroyed. So what HODL net position change is, it measures HODL coins, and HODL coins is liveliness, and liveliness is the sum of coin days destroyed over coin days created. Coin days created is just the number of coins ever created by day, right? And we can get that by looking at the amount of rewards coming in. So if we take the ratio of coin days destroyed to coin days created, right, running sum over the lifespan of Bitcoin, this sort of gives us a measure of like how active the Bitcoin network is, right? So if we invert that, right, you subtract 1 from the ratio and then multiply by supply, that gives us the number of coins that are held, right, not being moved. That's coins that are being held, right? So liveliness measures like activity, right, coins being destroyed, and then HODL coins measures coins not being moved. So what the HODL net position change measures, right, is that every month, right, we have this line chart. You can see on the Ember lens, it measures like how many coins were held that month. And so all it does is it takes the change month to month, right? The delta month to month, and it shows you like whether the number of held coins increase or decrease month to month. And like Chris said, right, it's kind of a lagging indicator. Typically, when there's a big price movement, right, like we hit new all-time highs, you'll see the HODL net position change decrease, right, because people are moving their coins and to capitalize on this new price environment and make money. But when price is low, they want to hold it. So instead, you'll see generally you'll see HODL coins increase, and that's why you see these long periods of like increasing HODL coins.
Thank you. Okay, so here's another question. I'll shoot it to Chris first, and then Christian, you can follow. What do you think the next digital asset ETF would be?
Yeah, it's a great question. I'd put my money on Solana or XRP if I had to bet on it. I We've already seen a Solana ETF released internationally, or at least rumored to be released in the next 30 days, and I think that's a huge sign that we may see this follow course in the U.S. Who will issue that? I couldn't say. An XRP ETF would be extremely interesting, especially given their history with the SEC. I think this would be also a highly likely case now that it's sort of definitive that they are a commodity and not a security. But in general, I would love to see a meme coin ETF. I would love to see a dog coin of some kind, or even a cat coin of some kind. I'd love to trade that in my 401k, and I'm here for that.
Great. And Christian?
Oh man, a Dogecoin ETF would go crazy. I don't think it'll happen, but if it did happen, that'd be wild. Yeah, I think Solana is probably most likely. If I had to get, like, if I had to bet on, I don't know, Polymarket or something, like, yeah, sure, I'd probably put my money on Solana. But what I don't know if we'll actually see that happen anytime soon. I feel like, the ETH ETF didn't make waves as much as people hoped. So, ETF, providers are probably, trying to be a little more reserved in what they tackle next. So yeah, we'll see. I think Solana is right. But Chris put this Dogecoin ETF in my mind, and I'm all in. So.
And so then what are your thoughts on institutional trends for the ETH and Bitcoin ETFs? And just to add on to that audience question, were either of you disappointed by the ETH ETF launch?
Yeah, I can take that one. I was not disappointed in the least. I think the complete opposite. I am ecstatic that we now have an ETF for both Bitcoin and Ethereum. Since I started in crypto years ago, my take has always been the adoption rate will grow when institutions arrive. We're seeing now institutions starting to arrive. I'm so excited for this. The history of Bitcoin and Ethereum was driven out by early adopters, by technologists, by people driven by math. You can trust the math. But in order for a seismic shift in the way that crypto is perceived, institutions are required. I think that right now with these ETFs, we're seeing a lot of maturity in the industry. We're seeing new derivatives like real world assets becoming a major play for institutions like BlackRock, for example. And I think we're going to see real world assets drive a lot of the next wave, especially on Ethereum or on new L1s that we have yet to see, or even L2s, L3s. I think it's just getting started. We also have a lot of shifts in terms of regulations, especially outside of the United States, countries like Hong Kong, the UK, Australia, and like James mentioned in the chat, Brazil, which approved the Solana ETF. We see a lot of other things like MiCA in Europe for stablecoin regulation.
Right.
That's now coming live. We're going to see a lot more of this, I hope, I expect. When the US does come around to the idea of crypto and starts having some type of rules and regulations around it, I think we're only going to see more adoption. And that adoption will go from off-chain centralized exchanges to eventually moving more on-chain and getting into more maybe longer-tailed assets, maybe longer-tailed blockchains. We're just getting started. We're still early.
I love that. And I think that is the perfect sentiment to wrap this up. So thank you to everyone who has joined our webinar. So the recording of this and the presentation, as well as the Pulling the Noise metric strategy research, will be emailed to you as soon as it is live. In the meantime, please go to amberlens.com to explore all of these metrics and many, many more. You're going to see dashboards about the Bitcoin and ETH ETFs. We have liquid staking, stable coins, RWA, DeFi lending, and much more. So if you'd also be interested in the complete history of all the metrics and the data underlying the metrics, please email us at sales@amberdata.com. We hope you enjoy, and we hope you join us for our next topic, which will be on the current state of spot trading. Christian, thank you so much for these insights. Thank you to our audience for joining, and everyone have a great day.
Thank you, Izzie.
Bye.
Thank you.